Early stage startups will most likely pivot because you could be fighting for something that is already dead. A lot of founders often miss it when you think that your numbers alone should tell a story. Your numbers don't often tell the story. Something founders often miss is that every stage of your business is attributed to a milestone. What I would like to hear as an investor is, I'm raising this $500,000 to expand into Kenya and hit a 1 million ARR in the next 12 to 6 months. Everyone fails. In fact, in venture capital, 9 out of 10 companies will fail. What I focus on when startups do fail is, what could we have done differently? What did we miss here? Did our predictions not catch? Was there something that could have been done better? Negotiations are not a battle to be won. They are the ability for you as a founder to be able to say what you want and get what you want. Now, founders often get stuck on valuations. Valuations are important, yes, but beyond the valuation, beyond the capital, you need to think for yourself first, is this investor even somebody I want to have on my cap table? Hi, my name is Folakemi Osho, and I am the General Manager at HOAQ. HOAQ is an early stage angel investment community that are backing businesses building for Africa and for Africans in the diaspora. We started all about 2020. It started with just 2 people that were in the tech space, and they had seen that was when the Paystack acquisition had come about. That was when the initial buzz into tech, everybody's so excited. So we started and thought, why not back these businesses? A lot of tech startup solutions are coming up, so why not back them? And since then, we've grown to over 850 angel investors across the continent that are deploying funds into these startups every month. So that is me and what I do in a nutshell, I guess. Before I joined the venture capital space, I'd been looking and seeing what African founders have been doing over time. At the time, it wasn't as glamorous as it is now. Founders were building quietly, some were building loudly, and it was just very interesting to see how they're building from the ground up, right? I studied accounting. I was used to numbers. Prior to this, I was in auditing, used to just balancing the sheet. You're seeing all these things coming, but you don't know exactly what is happening at the back. So I thought, this was very interesting, and I thought this was something I wanted to be a part of. How we are shaping the Africa that we do want to see. We always talk about how, Africa is now an emerging market, but we don't talk about the work that we've done to ensure this is happening. And that was how I got into the venture capital space. And over time, I've been validated around what I do, just because I don't only give capital, but I'm also ensuring that I'm equipping you with what you might need. Not what you are going to need, not might need, what you're going to need to be able to build the solution that you want to build and even scale. So over time, I have become, so to say, an operator where, we are not only deploying capital, we are also equipping founders with whatever they might need. And this has translated into my everyday, where I'm seeing that my involvement in your startup is yielding results. And these are the things that is yielding outcomes. We are seeing that startups are bigger and better than ever because, due to community, all that stuff, we're able to equip them with what they might need. So that's how I kind of got into venture capital and where I'm at right now. That's a good question. So I would answer this in 2 parts, because I think that there is what we know and there are other things that do go into evaluating startups. The usual is, there'll be an initial first call where you're speaking to the founders because you're trying to understand the product. You're trying to understand why now. You're trying to understand the problem that they're solving for, right? Then from the initial call, we then go into due diligence. At this time, you're speaking to the customers, you're speaking to the employees even, you're speaking to those who have interacted with the product, you're looking at the numbers, then there is conviction. After all of this is done, nobody is a wealth of knowledge. You have to, come back to your IC team and say, I've looked at this, does this make sense? in the next couple of years, where would they be? So that's the initial process. That's the initial process into investment. But then a lot goes into it, because first off, for an investor, outside of building an African ecosystem, we also think, what does the return look like for me as an investor? The investors also have people to report to. You have limited partners to report to. You have your angel investment community, in my case, to report to. So from there, you're thinking, one, is this the right founder? What particular knowledge does this founder have that makes them the right people to solve for this? What do you know that I don't know in solving this problem? So depth, founder market fit is very important. And also, another thing you look out for is this a real problem? Is this something that people are looking out for? Is this a problem that is keeping people up at night? Because there are two things. It could be a real life problem that you need to solve, and it could also be a nice to have. There are lots of nice to have, and that's not saying that a nice to have product is not good, no, but all of this would go into validating your product, and that is what is important.
2026 is here. How will your business grow this year? Would it be through partnerships? Would it be through sales? Would it be through content? Would it be through funding? At a Great Conversation Masterclass and Workshop, we are teaching exactly that. Practical strategies to create content that sells, secure partnerships, close more sales, and raise funds your business needs. Join me and other operators to double your business growth in 2026. Spots are limited. Reserve yours today.
We also look at, is the market ready for this? We see a lot of startups fail because the market is just not ready for it. And that is to say that the African ecosystem is still developing. We need to know that we need to map what we are building to what is readily available. 2, 3, 4, 5 things are things that we look out for when we are evaluating startups to decide whether to invest in them or not. Another thing I look out for when I'm investing in a startup is also ability to adapt. Early stage startups will most likely pivot. The solution you came in with is not necessarily the solution that would scale. So I'm looking at how the founder is also thinking about things. We've seen cases where founders can be rigid. I get it. It's your baby. You don't want to kind of see it go another way. But all of this plays into if your startup is going to succeed, because you could be fighting for something that is already dead. So are you able to easily adapt based on feedback, based on what is currently happening right now, and tailor your product to the solution you are originally trying to solve? It's not how we get there, it's that you're there. So ability to adapt. Another thing I look out for when I'm evaluating startups is your leadership skill. The founders play a large part in the success of a startup because there's so many things that go into it. And sometimes we are humans. You can lash out, you can be who you are. But how are you able to manage situations as they come along? Are you able to take advice? I watch how you respond when you think that you're being attacked. Because an investor-founder relationship is a partnership. At this point, you need to treat it like, so to say, like a marriage. You're accountable to me, I am accountable to you as well. If you come to me and tell me that you need something, as your investor, I should provide you that if I can. And you as my founder, you're accountable to me in the sense that I expect updates, I expect investor updates from you, I expect that you tell me what you need, I expect that you're conversing with me. I am not going to interfere in how you run your business, but just being able to be transparent with your investors, how you're speaking, are all the things that go into evaluating a startup and eventually investing in them. Oh, okay. All right. Okay. I have 3 that I could quickly touch on. The first one is not having a clear narrative. Before you start fundraising, you know your product. You know the problem you're trying to solve. You know the solution that you want to solve that problem with. And being able to talk through your problem into your solution, into why now, into why you, all of those dots do connect. A lot of founders often miss it when you think that your numbers alone should tell a story. Your numbers don't often tell the story. The numbers are great, but the numbers don't paint you the full picture. So while you are thinking of fundraising, you also need to start thinking of how you are going to have a clear narrative when speaking to anyone about this problem that you're solving for. A lot of people often miss that. Another thing would be what you're trying to achieve with that fund. Something founders often miss is that every stage of your business is attributed to a milestone. If you are raising at for instance, a seed stage, it should be attributed to a milestone. What I would like to hear as an investor is, I'm raising this $500,000 to expand into Kenya and hit a, 1 million ARR in the next 12 to 6 months. That tells me that you've thought through things. You're not just thinking, oh, because I've hit this traction, I then need to raise this money. No, sometimes you don't, if you don't need the money, don't do it, because now you're giving a part of your business away. And you need to think through it. It's not fast money. It's going to be a long-term partnership. You and I will be in business till you either, get acquired or you go public on stock exchange. So know what you want to achieve with the capital that you're raising. My last point would be, some founders often reach out to the investors either too late or too transactional. Well, people, if you are starting your fundraise or you're looking to start fundraising, I always encourage founders that get yourself in the room. You don't need to say, oh, I'm raising so at so in the next 5 months, I want to close my round. Get the conversation out there. You want people to know about what you're building. You want the investors rather, to be the ones to come to you and say, I've been watching you. I see that you're building this. When you're ready, let me know. That is how it should work. Because again, investors see a lot of things every day. And because we see a lot of things every day, we know the bluff. And while, you could be nodding and smiling and doing the most, we're also picking all the things that's happening around us. I think I've spoken about, sharing investor updates and all those things, right? I always encourage, so the way I work, where, we review the pipeline, we do IC. If you're not a fit right now, I would send you a text or send you an email rather and say, reach back to me in 6 months or put me on your investor updates. That way, I'm at the back of your mind, you are at the back of my mind, because I'm seeing your updates coming. I'm seeing how you're making progress or not making progress, which is okay too. So approaching investors when you are almost dying or when you think that, oh my God, I'm in sometimes doesn't work, because I'm also thinking at the back of my mind that, are you reaching out to me because you have almost run out of money? Is this a case where there's no more money here and you're just like, oh, let me quickly, which could be the case, but now we don't have a relationship. You've just now come to me and say you need some money. So founders need to have a clear narrative, connect all of the dots, why you're building for this, why you're doing this now, why this is the solution that you've proposed for this problem. Also, you should be able to connect your capital to the key milestones that you're looking to achieve. And the last thing is, don't approach investors transactionally or too late. Those 3 things are very important when you're thinking about fundraising. Seed, Series A, and Series B are fundraising stages that are essential while growing your business. These stages do come in before you get acquired or you go on the stock exchange. But these are not the only stages in fundraising. They're just the most common ones in this part of the world. And at your seed stage, in simple terms, your seed stage is the stage where you are proving your product, you're proving your solution to your customers. Is this a product that they care for? Is this something that they're willing to pay for? At this stage is still a validation stage, because you are figuring out if your product works, if your solution works, if your customers are even willing to pay for this. Then at your Series A, you are proving defensibility. At this point, you have some traction. You have proven that your product works. People are willing to pay for it. People are using it, actively using it. But at this stage, you are proving that your product or your business anyway could be predictable. You could somewhat anticipate what the next couple of years will look like for you based on what you've seen in the past, based on what your numbers are currently at. You are solidifying yourself into the ecosystem as one of the players at this time, right? And at your Series B is really proving scalability. Are you able to scale with these products now? Now that you've proven that you're here, what is next for this business? Are you scaling into other markets? What does this look like for you? Now it's just about, owning a fraction of that market that you're playing at. So that is, in simple terms, seed, proving your products, your solution. Series A, defensibility. Are you predictable? Series B, scaling. Pre-seed, at your pre-seed stage, is still very early. You are validating the market, you are testing out products, what works, what doesn't work. At this point, you are engaging with customers, but you are not so much expecting that they pay for it. So at pre-seed stage, you are still proving that the solution works. You are still proving that this is something that will take off the ground. You are proving that the market is ready for this. Beyond the numbers, there are two elements in evaluating a startup. So we have the founders and then we have the stakeholders. In regards to the founders, what you're looking at is how do they relate to their customers? Do they take in customer feedback? It's so funny, we've spoken about, social media, Twitter and all that stuff. In today's world, your customers are on Twitter, they are on Instagram, they are on all the social media networks you can think of. So how are you interacting with them? The strongest founders interact with their customers. They know their customers intimately. I was watching something that Bumper did recently, and they had interviewed one of the customers. And I remember watching it and I was thinking, Kevin actually knows all these people and actually was saying their numbers. So the best founders know their customers intimately. They have their biggest customers and phone numbers. And that is how business works. So all of these things, I'm looking at how you're telling them to me. I'm listening to you. I'm looking at how you interact with your customers. Another thing would just be how you manage your failures. Everyone fails. In fact, in venture capital, 9 out of 10 companies will fail. But as you're failing, are you learning from your failures? Are you ensuring that you're taking lessons from it rather than, so much is blame? So these are the things that we look out for when we are evaluating beyond numbers. Because as you grow in stages, eventually becomes outside of the numbers. Can this stand by itself? Can the managing team ensure that this will continue to go? We see situations where co-founders fight and then that's the end of the business. So how are you taking failures? How are you interacting with your customers? How are you, even down to culture, employee culture, decision making? How are you thinking through things? How are you thinking through your decisions? Are you somebody that makes all the decisions on your own without consulting anyone? How do you interact with your partners? These are the things that we look out for when we are evaluating a startup beyond numbers. How I would personally speak to your partners, those that you've partnered with for a fintech, those that you've integrated with. Do you communicate well? Are you always on time? Are you tardy? All of this day to day are things that we also evaluate beyond the numbers that you've shown. Numbers will tell you what is happening, but not why is happening. It could be a case of, you've delayed your other partners. No, now they've pulled out. Now they've gone away with the customers that you could be helping. Why is that? How are you solving for that? How are you ensuring that you're not only thinking about the numbers, but you're also thinking about all the other factors surrounding the numbers? So these are the things that we look out for. I look out for when I am evaluating a startup beyond their numbers. Oh, mentorship is the biggest thing. I think that beyond capital, having somebody that you could speak to. You hear like a lot of founders say they're burnt out. You feel like you're alone in this. And that's when mentorship comes in. Somebody has gone ahead of you. So why don't you leverage those that have gone ahead of you to solve the things that you need to solve for? For us at HOAQ, we take that very seriously because we know Our community is a community of professionals, operators, people across the continent. We've seen businesses being built and being grown. So we offer, outside of capital, I will tell you, come to us for whatever you need. Because again, how are you not leveraging a community of over 850 people across the continent? And that is just us. We also have other collectives as well that are doing the same thing. So mentorship while building is very important. You've seen people go ahead of you. Why not identify those people that you think can be directly linked to what you're trying to do? Get in touch with them, ask people to make introductions, and get talking. You don't have to do it alone. You have a community, literally a community you can build on. Failure is something that comes along with venture capital. We are not aware that startups will fail. In fact, there is a golden rule that 9 out of 10 startups will fail. And with that being said, there's always room for accountability, where the failure is a process. Is a process. There's no need for blame. There's no need for, is a lesson. And I would always say that, every startup that fails is a lesson. In fact, the strongest founders I know, they're on their second, third startups because, their first ones have failed. They've learned from it and they've taken all of those learnings now into what they're building now.
2026 is here. How will your business grow this year? Will it be through partnerships? Will it be through sales? Will it be through content? Will it be through funding? At a Great Conversation Masterclass and workshop, we are teaching exactly that. Practical strategies to create content that sells, secure partnerships, close more sales, and raise funds your business needs. Join me and other operators to double your business growth in 2026. Spots are limited. Reserve yours today.
So startups will always fail. There's always room for accountability. What I focus on when startups do fail is what could we have done differently? What did we miss here? Did our predictions not catch? Was there something that could have been done better? However, while that is being said, founders need to be as transparent with their investors at this time as much as you can be. Because when something does fail, life does go on. You might want to build something another time. You will still need investors if you're doing something different. So at that time, founders need to also know that they're accountable to their investors. Were you transparent with the dealings? Is that something that could have been done better? The investors also have an obligation. As I'm giving you money, somebody is giving me money. So literally, if you're not transparent with me, I can't be transparent with my investors. And in turn, my investors would not think that, because if I don't come to them with something tangible to say, literally being transparent with them, they will not want to give me money. If they don't give me money, I don't give you money. So I encourage founders to be as transparent as they can in these situations because the ecosystem is still very, very new. We are literally still building it up. And I feel like once we are transparent with each other in our dealings, we are able to shape the ecosystem to what it can be. A few key trends stand out. One is increase in infrastructure, increasing interest in infrastructure. We are seeing that with Chowdeck, we're seeing that with Temple Plus, we're seeing that with Temai. Another one I would mention is the fact that founders are getting more comfortable with mergers and acquisitions. We are seeing that founders that have built something and another founders build something are comfortable merging those things to sort of build a larger innovation. We've seen that with Flutterwave with Mono. We're also seeing that with Money Points and Kobo Kobo. You could even merge just to enter another market because that's what you need at this time for your business. So we're seeing a lot of new innovations and strategies getting comfortable. We're getting comfortable with these new strategies. And also another key trend would be that the corporate businesses we see today are getting more comfortable with even building on tech solutions, on new infrastructures. In the past, you would not see that, especially in the African setting, where a traditional business is not only partnering with new solutions, but they are also now investing in them, which is a new trend and is a validation that we are growing. we have moved away from sentiment or hype to actually building sustainable businesses. And these are some of the key trends that are shaping the Africa ecosystem that we see today. First things first, which I often laugh about, is negotiations are not a battle to be won. They are the ability for you as a founder to be able to say what you want and get what you want. Now, founders often get stuck on valuations. Valuations are important, yes, but beyond the valuations, beyond the valuation, beyond the capital, you need to think for yourself first: is this investor even somebody I want to have on my cap table? What does this investor mean for me in the long term? Is this something that would bring me more business? Is this an investor that would open me up to more global investors? Because the same way we have the founder ecosystem, we also have the investor ecosystem. And when negotiating, there's no battle to be won. Oftentimes, founders, because you're stuck on your valuation, you often miss out on what could have been. And again, this is where, like we mentioned earlier, this is where mentoring comes in. This is when you want to seek advice from those that can help you in terms of negotiations. I've had a time where a founder had reached out, they were going to get acquired by another company. And we had been talking about the transaction for quite a while, running the numbers. And at the end of the day, it wasn't a good acquire for them. And imagine if at this point there had been no conversations around it. You had just said, oh, looks like money, and you're just taking it. That would have been the end of your business. So when approaching negotiations, think outside the valuation. Think what it means for your business. Also, another thing I would highlight is the governance. Oftentimes, founders get stuck on the fact that they think that the investors want to take over their business. And that's might not be true. Investors have more confidence in you when you take in their inputs. So for your lead investor to say they want a board on the seat, that should be the least of your worries. Because if your lead investor, the person that's giving you so much money, is saying, we're not going to take control of your business, we just want to be aware of what's happening in the business, that's a win-win for everybody. Nobody is looking to come in and take all of the seats. One thing founders should take into consideration is it is not a battle, and also governance is put in place for a reason. It's to hold all of us accountable. So when going into negotiations, you're not only thinking the valuations, you're not only thinking capital, you're also thinking what it means for your business, you're thinking what it means for your employees, because these are the people that are working together with you to build this particular solution. In regards to documentation, as a first-time fundraiser, right, what you want to do is have all of your documents together. Now, if you're raising for the first time, I would imagine that is your pre-seed stage. And at this time, investors already know that you're not profitable. You're not going to be profitable at this stage. You have some sort of traction, but are you documenting this properly? Well, earlier I mentioned that when we are evaluating startups, there's a process called due diligence process. And at this process, we are looking at your documents, have you registered here? Do you have the licenses that you might need? Even if you don't have the licenses, who are you leveraging? What are all of those documents? Best have a demo ready. If you have customer testimonials, put all of those things in a folder. Your previous financials, your financial projections, all of this should be in a folder. And it gives the investor so much confidence, because now you're thinking about a lot of things. You're not all over the place. You could be all over the place, but I can tell that you are meticulous about how you're building when I see that all of those documents are readily available. Now, nobody's saying that, once you meet an investor, you're sending them all your documents. No. When you get to that particular stage, have it ready. When I tell you, oh, please send me your data room, you have everything ready. You could put your, all of this on Qatar. Some people use Qatar. It's a bit expensive. You could use Rallycap. In fact, you could even go to ChatGPT and ask ChatGPT to give you all the softwares that you can use to arrange. In fact, you could even use as easy as Airtable. You could use Pitchwise. So all of these things are readily available to you. when you're getting ready for your fundraise. So now the first thing would be to get your story right. Know why you're building what you're building. Know why you're solving this problem. Know why this is the right time to solve this particular problem. Know your market. We often miss it when we think that we are not who we are and you're solving for a different market. You could be solving for a different market, but just knowing the market you're solving for is enough confidence to give an investor that, you know what, this is it. I've done all of this work. I've done my market validation. I've shown that this is something that is going to work. That, then having your documents together, knowing the right investors to approach. We often see that for somebody that sees pipeline every other day, deals coming every other day, you can easily know when a founder has not done their homework with their submission, because every VC has a thesis. For some is they only invest in agriculture. For some, they only invest in healthcare. Now we have women-led what they call it, VCs as well. So who are these right people that I need to connect with? Am I going to the right places? We have lots and lots of mixers. We often even joke that, lots of business transactions do go on when at a mixer. I just, having a drink and you're telling me things. So first of all, are you interacting with the right people? Are you interacting with the right people for your particular business? Are you ensuring that you're keeping long-term partnerships with them? I've had instances where, founders will just reach out, oh, how are you? And before you know it, we're already talking, oh, so how is it going? At this point, you did not need to message me out. Like you could have just waited till it was time to fundraise. But just a little message here and there, it keeps people at the top of your mind. You want them to know what you're solving for. You want them to be the ones to come to you and say, when are you ready? I'm ready for you. So all these little things that we often think don't matter, do matter when we're fundraising.